Which fund would have made you more money if you put $10,000 into it? SCHG or QQQ? I've collected all of the data over the last 15 years for both and simulated this, and the results are very interesting. Both of these ETFs are considered some of the best growth funds. QQQ is known for high returns using a tech-focused approach, while SCHG has built a reputation on high returns using large-cap companies. In this video, we'll dive into both of these ETFs, including their past and current performance, holdings, dividends, and a side-by-side comparison using a $10,000 investment. Let's dive into our first competitor, QQQ. The Invesco QQQ ETF is more than just a tech-heavy index fund. It's a direct line into the heart of US innovation. By tracking the NASDAQ 100 index, QQQ gives investors exposure to 100 of the largest non-financial companies listed on the NASDAQ. This makes it one of the most iconic and actively traded ETFs in the world. QQQ is heavily tilted towards technology, with 59% of its weight in tech, followed by 20% in consumer discretionary, and 5% in healthcare. That sector breakdown sets the stage for what's inside. When we dive into the holdings, it's no surprise to see Apple, Microsoft, and Nvidia leading the way, together making up over 20% of the fund. Add in Amazon, Meta, and Tesla, and you've built a portfolio around innovation and market leadership. Now, if those tech giants weren't impressive enough, wait until you see the dividends. Although QQQ is known as a growth-first ETF, one underrated feature is its dividend consistency. It's paid dividends for 17 consecutive years, with 3 straight years of growth, and boasts a surprising 10 to 19% dividend growth rate over the past decade. While the yield is modest, around 0.6%, its steady growth makes it appealing for investors who want both capital appreciation and a touch of passive income. So why is QQQ so popular? It's the go-to fund for younger investors, tech enthusiasts, and anyone looking to ride the momentum of companies shaping the future. Now let's dive into our competitor. SCHG is the Schwab U.S. Large Cap Growth ETF, managed by Charles Schwab Asset Management. Its goal is to closely track the Dow Jones U.S. Large Cap Growth Index, providing exposure to more than 225 of the largest growth-focused companies in the U.S. By bundling these high-performing large caps, SCHG has established itself as a standout option in the world of growth ETFs. Looking at the sector breakdown, SCHG leans heavily toward technology, which makes up about 45% of the fund. That's followed by communication services, consumer discretionary, and healthcare, each contributing roughly 10 to 12%. When we dig into the top holdings, it's no surprise to find Apple, Microsoft, Nvidia, and Amazon leading the charge, together making up over 30% of the fund. Much like QQQ, these tech giants are the core drivers behind SCHG's growth potential. Now, while SCHG is clearly focused on capital appreciation, it also pays a small dividend. The yield sits around 0.5%, and SCHG has delivered 15 consecutive years of dividend payments, with 2 years of dividend growth. Over the last decade, it's maintained an average dividend growth rate of about 5%. So while dividends aren't the main draw here, they do add a layer of return for long-term investors. So why is SCHG so popular? It's often included in conversations among investors who have a high risk tolerance or a strong conviction in the long-term growth of the technology sector. So now that we've seen what each ETF is made of, it's time to put them head to head. Back in 2010, SCHG was trading at just $3.42 per share. That means a $10,000 investment would have picked up over 3,000 shares. Now keep in mind, this was still in the recovery phase following the 2008 financial crisis. Fast forward just 3 years later to the end of 2013, and SCHG had climbed to around $5.60 per share. By reinvesting your dividends along the way, those 3,000 shares would have grown slightly, just over 3,100 in total. But here's the kicker. That initial $10,000 investment would have turned into roughly $17,500. That's a 75% gain in just 3 years, outperforming the S&P 500, which would have returned around 65% in that same period. Now let's move ahead to year 7 in 2017. SCHG would be trading closer to $9 per share, more than double where it started. Even though the dividend growth had cooled off a bit in 2016 and 2017, your investment would now be worth around $28,000. In just 7 years, you would have nearly tripled your money. But the best part, we're not done yet. By year 10 in 2020, SCHG would have reached around $16 per share. Dividends alone would have added $1,200 in value if reinvested. Altogether, that $10,000 investment would now be worth around $41,000. And all of this happened in just over a decade. Now let's look at QQQ. Back in 2010, it traded around $48 per share. A $10,000 investment would have bought about 217 shares. Just 3 years later, in 2013, the share price had nearly doubled to $87, pushing your investment close to $19,700. Fast forward to 2017, the midpoint of our experiment, QQQ hit around $156 per share, and factoring in reinvested dividends, the total return would now be around $26,000. But here's where QQQ really takes off. By 2020, shares climbed to $312 per share, more than 6 times the original price, and the dividends added another $2,800 in value. That initial $10,000, that's now worth around $65,000. Now let's take a look at our final data points here to bring us up to 2025. So fast forward to May 2025, QQQ is trading around $490 per share, and that same $10,000 has grown to roughly $110,000, over a 10 times return. Now let's bring in SCHG. As of May 2025, SCHG would have turned that $10,000 into $74,000, a 7 times return. Still impressive, but didn't quite keep pace with QQQ. But beyond the numbers, something really stood out as I dug through the data: the volatility. These two ETFs may look similar on the surface, but their journeys are a little bit different. Now let's look at how this actually played out on a chart, because these numbers only tell part of the story. We're looking at the total return over time expressed as a dollar value. QQQ is in the red and SCHG is in the blue. We know that QQQ outperformed overall, but let's look a little deeper into the volatility. In Q4 of 2021, QQQ peaked with a portfolio value around $86,000, but by Q4 of 2022, it had dropped to around $54,000. That's a 37% decline in just 1 year. Now let's compare that to SCHG. In Q4 of 2021, it hit around $56,000 and fell to around $34,000 in Q4 2022, a similar drawdown of about 39%. So even though these two funds hold different companies, SCHG being slightly more weighted towards financials and healthcare, they experienced nearly identical levels of volatility during that specific period. It's also worth noting that tech stocks, which dominate QQQ, have been the clear outperformers over the last 15 years, while financials and healthcare, which SCHG is a bit heavier in, have lagged behind. Now, if you did enjoy this video, I've done several other ETF comparisons just like it, and I'll link 2 here now on the screen that I think you'll love. Don't forget to leave a like and subscribe if you're into ETF investing and want to see more videos just like this one.